So first of all, welcome again to the conference, and now to our panel on what Series A investors look for in a marketplace. I am a Series A investor myself. However, I only invest in ground transportation companies. Therefore, I can be on the edge of this couch and ask the real Series A investors what they look for in companies of all kinds, not just ground transportation companies. So let's start out. We have an illustrious group of people here. Maybe you can each introduce yourselves briefly.
Should I start? Okay, sure. My name is Rishi Garg. I'm a partner at the Mayfield Fund. We are an early stage venture capital firm, really committed to being Series A, almost all Series A investments. Marketplace companies in our portfolio include Series A bets in Lyft and Poshmark. We have a few others on the way. And my prior roles were at companies like Square, Twitter, Google, and MTV Networks.
So I'm Niko Bonatsos. I'm a partner at General Catalyst. We're a multi-stage firm in the business of partnering with ridiculously ambitious founders. We're building category-defining businesses, and we write checks that range from $500,000 to $150 million.
That's a good intro.
Can repeat, thank you.
Yeah, I do that.
A/B testing.
But bigger, we can write slightly larger checks.
Oh, good.
I'm Ben Narasin. I was an entrepreneur for 25 years, a seed investor for 8, and I've been a VC for 4. I'm currently at NEA, which is where I hope I live the rest of my life. It's a phenomenal group of folks. NEA is, with the exception of SoftBank, the largest venture firm in the world. $20 billion in committed capital. We just celebrated our 40-year anniversary, funded 1,000 companies, 225 of them became public, 350-ish got sold. So we have almost 400 and change left in the portfolio of just great people trying to get things done. We also look for people with unbounded ambition to create enormous things.
Very good. And my name is Daniel Hoffer. I'm a managing director with Autotech, and we only do ground transportation deals.
We like the focus.
Yeah.
Yes.
Focus helps. There's a whole strategy around focus.
Mm-hmm.
So
There's a venture firm with that name too.
Yes, there was a venture firm with that name.
Didn't work out.
So the first question, let's start with the basics. What is a marketplace? How do you guys define a marketplace?
It's funny, one of my partners, Jonathan Golden's here with me as well, and so you guys will have another NEA person to talk to later. And we were talking about this on the walkover, sort of trends in marketplaces and how they're defined and things like that. And ultimately, to me, it's the balance of supply and demand in two different ecosystems, or two different, the buyers and the sellers coming together to create a transaction in a way that's more seamless and transparent and beneficial to everybody involved than it has been before. And you can see that in industrial cases, commercial cases, consumer cases. Lending Club was a marketplace for money. There's marketplaces for everything, literally everything. And I think as long as that's been digitized and transformed, then that's the type of marketplace I'm intrigued by. I don't think we've seen any marketplaces that aren't digital, although who knows, one day there might be one.
Retail?
I mean, that we would invest in. Retail is a marketplace in terms of like go into a big massive shop that has everything in the world, like Amazon, but in a store.
The Amazon marketplace, yeah.
Yeah.
But in a physical brick and mortar environment.
Nordstrom.
One of the questions is, do you need to know the person that you're, or the entity that you're transacting with directly, or can they be?
To be in a marketplace?
Yeah.
You don't need to. I mean, anonymous marketplaces are, they're the right solutions in certain cases, to be sure. We think about it as distinct from e-commerce, where it's not just buyers and sellers on two sides of a marketplace, but great marketplaces at least are defined by having some unusual value that makes the participation in the marketplace more than just another channel, more than just another place to acquire customers, another place to sell your wares, or to acquire something. And so, the kind of the heart of the question from a Series A investor perspective is, how do you think about what value the entity, the marketplace company, is adding to the ecosystem, and is everyone in the ecosystem a lot better off for participating in the marketplace? And so that's an important distinction, I think, just between traditional e-commerce and whether or not you really have marketplace dynamics happening. We also think about them distinctly from attention marketplaces. I mentioned I used to be at Twitter, so we think a lot about Google, Twitter, Facebook. A lot of the media marketplaces are actually marketplaces for advertising, marketplaces for attention. And they have a lot of the similar dynamics, but this idea of being in the transaction flow and actually buying and selling something, I think, is pretty important for the definition as well.
Yeah, it's great when there's payment enabled. It increases the enterprise value, and in general, if you are right in between, where money changes hands, you're going to find a way to monetize. We also like marketplaces that are that have software tools that can lock in some of either the supply or the demand side, make it much stickier for them, make it harder, for others to emerge. So there are many, many things. But I think, man, you give pretty good definition, where supply meets demand in a very efficient manner, and technology can make life easier, as well as the internet, like leveraging the fact that it's a powerhouse for distribution. So you can find a long tail of sellers and buyers and everywhere in the world.
Although I think there's just one other little piece here as relates to sort of Series A investors and beyond. What used to be considered a marketplace was sometimes something centered entirely on GMV. And
what's GMV?
Gross market value. So like when transactions don't happen on the marketplace, but people match up for whatever reason. There was a business in I won't name the company, but they were in the business of letting people bid for buildings and construction, and so billions of dollars of bids flowed through that quote unquote marketplace. There was a time when people would fund off of GMV. I think those days, you might differ, are almost entirely gone. If you don't have a path to monetizing that's pretty obvious and proven, it's really, really hard to raise material dollars. Maybe it's okay for A, it's certainly not for B. A friend of mine once said to me I brought him a deal and I said, "You'll love this, it's a great Trojan horse." And their response was something like, "I'll wait till the soldiers come out of the belly, because you can light that horse on fire." So I don't want a burning horse filled with dead people. I want to see that you've conquered the particular building you're attacking.
What if it's growing like 10x year over year? And it's like real GMV?
So in fairness,
it's not like people buying cars and like putting offers out there.
I don't know. You got to define. We actually had this debate internally, like what's real GMV, and is it truly recognizable? I had a business that I personally invested in, which raised its A, its B, and its C off of GMV growth, and they're now going to get sold.
Oh, good.
Because they don't have a business, because they can't monetize.
Sold on unattractive terms, or attractive.
Well, the question is what is, and this is the question as an investor, is how much do you believe that you sit enough in a transaction flow that your likelihood of actually becoming a participant in the ecosystem where funds are flowing through you is likely, and sometimes it turns out that your hypothesis is wrong, and sometimes it turns out the hypothesis is right. I can think of a company in your portfolio that has some important questions about that, and that's actually really great. And you can see how they're thinking through that and trying to make sure that happens, right? So,
is there a certain percentage margin, or I think the term is rake, that you guys look for as Series A investors that would give you comfort around this topic, or what is the profile that would either give you comfort or give you the absence of comfort with regard to the GMV and margin/rake relationship?
Well, I mean, it depends on the category, right? Yeah. It's really hard, to give blanket answer here. Like, I personally get really worried when, like, you see a marketplace that's charging 40, 50, 60%, because it feels like, like kind of too high. And often you may have to worry about disintermediation risk. It's always good to have in mind that at any given moment in time, you're subsidizing one of the two sides, and constantly be eager to A/B test where the pricing should be. In the early days, especially what I pay attention to at the Series A stage, is there one side that it's basically free, With WAG, the dog walkers were really free, eager to sign up. A lot of people love to spend time with dogs.
Do you mean free from an acquisition cost?
Yeah, free from an acquisition standpoint.
Okay, so one side is very cheap to acquire. That's what you're saying.
Yeah, that's what I pay a lot of attention to in the early days. And then the other thing I pay a lot of attention to is there a high frequency of transactions, high frequency of use? Because if you have that, especially when you're, first-time founders, operationally it's much more challenging. It buys you more time.
So Niko, last night you encouraged me to ask you difficult questions on the panel. So
please.
So when you talk about a frequency of transaction, how does that relate to, for example, the travel industry, where people are only traveling, a couple times a year? It's a different kind of profile. So how do you evaluate that and the relative frequency of transactions?
Yes, so the good news is in the travel industry, especially if you're going after, hotels, there's like the AOV is pretty high. You guys
what is AOV?
Average order value is pretty high, and over there you can capture like 20, 30, sometimes even more, and the math can work really, really beautifully.
This is a great example, though, where when you think about what's that percentage, because it is always going to vary. You get paid virtually nothing for airline tickets. So unless you're selling first-class tickets, you're not going to make any real money. So you have to have huge volume.
$8 otherwise. It's painful.
Right? But
Avoid
hotels
it.
will pay you a lot,
Yeah.
and packages will pay even more. So there's interesting businesses right now in Europe that are doing sort of tour experiences and making really meaningful amounts of both growth of the overall business, and their take is reasonable, and they can. It does have to foot. At the end of the day, if your sort of ultimate goal is to have not everybody will take their companies public. Obviously, that's not going to be a realistic outcome. But I think that you have to back something as a Series A investor, you have to have a belief that that could happen. And if that's going to happen, what's the market going to expect from you? High volume, incredible growth, solid margins, if not phenomenal margins. And the less you have of any of those three, the less you will be able to justify from a multiple standpoint. So if your growth is like this, and your average transaction is $10,000, you're only taking 1%, well, probably could handle that. And if your growth is like this and your average transaction is $1, but on total you're doing $100 million of revenue this year and you're going to 200 or 300, the velocity is also incredibly important. It's not just the margin underneath. My earlier point was just that too many entrepreneurs for too long have had the luxury of being able to raise on GMV with the promise that they will figure it out. I don't believe that promise is valid anymore. I think you have to show me how you're going to get paid. You could step in front of billions of dollars, but if you can't take, quick analogy, if you're the phone company and you own the phone, and you're basically the line between Goldman Sachs and its biggest customer, and trillions of dollars covers that line, you don't get to call that GMV. You don't get a piece of that action. You get paid by the minute. So you got to make sure you have a way to tap in.
So going back to the basics here, what do you guys look for in a Series A marketplace investment?
I think we just talked about a bunch of them, but I'll add some stuff here. One thing we really care about is at the Series A stage, you don't have everything figured out, but we do care a lot about whether or not, from a product perspective, all participants in the marketplace are getting something really unique. So it goes back to this question even about rake, right? There's always going to be substitutes. There's usually substitutes for a transaction that's occurring on a marketplace. So the question is are the things that the company are doing to make that marketplace valuable, are they really differentiated? Are they things that only that company can become excellent at doing? Because that means that you have a right to earn your percentage of that transaction. Many great marketplaces even charge above on a total transaction value basis, maybe what the substitute would charge, but they're earning the right to sort of be in market with that buyer and seller. And so the question is, we look for where technology is supporting that relationship, where product ingenuity is supporting that relationship. We love to be in the transaction flow. Frequency of transactions is a nice thing to have. It doesn't happen in every case, but it's always great. And we also, we've all kind of talked about sort of ambitious founders, and marketplaces are really hard in some ways because you're not just selling one thing to one person, you're often trying to capably sell several things to several different groups of people. And managing the health of a marketplace is a notoriously challenging thing to do as a company grows. And so you need particularly ambitious founders often. We spend most of our time actually focusing on the people behind the companies that we invest in. And we love seeing when entrepreneurs have both, or the entrepreneurial team has both the left brain and a right brain approach, because there's often a combination of incredible product sense and empathy with your users, as well as being really deep in the numbers. And the operating metrics of the business to maintain that health that go together to kind of create something special.
I feel like we could talk for an hour and a half on these topics, and we're almost out of time, amazingly. But maybe.
Jeez, what happened?
Yeah,
We just got up here.
But
Gary did it to us.
Gary did it. Maybe you can talk briefly about shadow markets. What is a shadow market, and how do you think about shadow markets when it comes to your investment analysis?
So, in some instances where there hasn't been a marketplace for that specific category, a shadow market is, frankly, the set of alternatives that the buyers and the sellers are using in order to meet their needs. And it's often, like a pretty good indication of what the challenges are in that particular space. It's also a pretty good early indication of if you have, people go out of their way to try to find solutions, and then with a really easy, simple to use online marketplace, it starts raining, either, demand with a shitty product, or you're getting the supply for free. It's a good proxy, to start thinking about what's going on. At the same time, you should be a little bit more thoughtful and try to understand what are the reasons why an online marketplace has not existed over there? So, for example, if it's something that people would only need, once every couple of years, or if it's a category where the personal relationship matters a lot, like you want to see if it's a services marketplace, the individual, coming into your house doing the job, probably to make you, think about like what are some of the challenges that are going to be coming up.
Yeah, one of my favorite examples of a shadow marketplace, to Niko's point, is the secondary ticket market was kind of, scalpers. It was like because I think about shadow markets are like not just markets that are not online, which could be offline markets, but markets that actually operate in the shadows because the costs of regulatory visibility, if you will, right, are to make the transaction cost very high. And so StubHub is a really good example of this, just because, and all the sort of ticket companies, because they basically had to spend so much of their operational time and costs in guaranteeing fulfillment on both sides of the transaction. That was the hardest thing. That's what made the market. That's why the market was sort of in the shadows. And so I think what Niko said is right on, in that the thing that makes everyone angry about the shadow market is usually the thing you have to solve. But if once solved, you can build a very interesting marketplace.
I think it's interesting to see how some marketplaces haven't cracked yet. There was a company, it's not a marketplace company, but it's a great example of this. There's a SaaS software company in Santa Barbara that built construction industry software. And that guy bootstrapped for 12 years. And then he raised like $100 million and he's worth billions. It just took forever for that industry to adopt. And I think that's a really important criteria. Having said that, I want to answer the question you asked before that, because it's sort of it is in essence the title of this talk. What are we looking for Series A investment? I don't think it's any different for marketplace investments than for any other. I need 5 things. People, a great idea, and a huge market if it works. The people are paramount. If you don't have phenomenal driven people that are unwilling to lose, you shouldn't be making the investment, because entrepreneurship is an incredibly difficult journey. Anybody here that's decided they want to be an entrepreneur because they read something fun in TechCrunch and thought that would be cool? If you haven't figured it out yet, it is a miserable life for a very long time. You become an overnight success after 10 or 20 or 30 years of trying. There's nothing you can do that's harder other than being a first responder or putting out oil well fires. And it's just an incredibly difficult thing. So if you're willing to give up, you are going to. If it is one of your options, you should leave now and get a job. So the quality of the people is critically important.
Portfolio companies hiring?
Actually, I've got some great portfolio companies that could use people that don't want to be entrepreneurs but want to be hardworking, awesome folks. Although, having said that, like, we could go into this topic of work-life balance, and I can tell you that's also an illusion, because if you're going to be an entrepreneur, don't pretend that that's going to happen for you for a good solid decade. But the quality of the idea and the size of opportunity are also critical. So if you're building a marketplace for, I won't go into dog walking, I'll go with dog collars. We're going to build the world's best dog collar marketplace. Okay, you might be phenomenal, but I'm not that big a fan of your idea, and no matter how well you do, it's not going to be that big. Right? And so when you look at the markets you could attack, the fact that they aren't yet attacked could be that they're not ready to be attacked, and also might not be worth attacking. There are a lot of huge markets that haven't been disintermediated yet and had technology in them, but I think when you think about at least, and I'd argue that different partners in different firms, even inside the firms, have different views, but the quality of the people is probably true for everybody on this board. The quality of idea, different people feel like it's okay to pivot. I don't love pivots because usually they fail in very small cases. Like, I can count them on one hand in the last 17 years that have worked, and there's many hundreds that didn't. But the big opportunity at the end, for traditional tier 1 venture to fund some company, they've got to believe in a really big outcome. They've got to believe in a possibility of an IPO. They've got to believe in my opinion alone, unbounded upside. You don't have unbounded upside, you shouldn't be talking to me. You should be talking to somebody else that wants smaller outcomes.
All right. On that note, would love to open it up to Q&A from the audience. Yes.
How do you think about marketplaces, asset-heavy marketplaces that require substantial capital to grow? You mentioned great people, large markets. They also require billions of dollars of capital. Does that give you any pause in terms of how you think about strategy there?
In the investment in order to create the marketplace in the first place is asset heavy, or the products themselves are asset heavy, like bulldozers?
I think it means like you're touching the product like goat. Like, you have to actually touch the product.
Real estate or vehicles require billions of capital to acquire the assets or to make the market.
Yeah, you have to buy the supply side.
Yeah, except I would challenge the premise in that if you're buying them, then it's not really a marketplace.
So, you carry
it's really the supply and demand equilibrium you create between the buyer and the seller. So you're a transaction creator. So there's, as an example of successful business, I funded one which didn't succeed before I joined NEA in construction equipment rentals. It's a marketplace. and they have, probably a couple $100 million worth of equipment that they rent out to people, and that's a really interesting model. But they're not going to touch the ownership of that equipment. Now, the entrepreneur did come up with a really elegant way to get that equipment in via sort of incenting others to own it and to put it into his marketplace. But I don't think it's a problem how expensive the equipment is or whatever the item is, as long as the value that's created is better for everybody involved. And if you, I guess to oversimplify this in terms of just the way my little tiny pea brain thinks about it, if you own the stuff, you're running a retail store. If you're connecting people on the buy side and the sell side, then you're running a marketplace.
Yeah, the other way to think about it is like the velocity that you can have and the timing of when you're getting started. So if you got started, a few years ago, we have been living through the good times. So probably, you could get away with it. But if you're not a very successful fundraiser, it goes back to the people, and have the ridiculous patience required, it goes back to the people coming again. From our side, it would be like, oh, when is the right time, to come in and invest here? Is this business really inflecting, or we can wait for some longer, like a downturn is coming up, and what's going to happen then?
Yeah. And I'll just say, if you're going to touch the assets, so there's a lot of marketplaces that do have buyers and sellers, but there's a big issue with like I mentioned StubHub, where it's like, are these assets really the right assets? And then suddenly it's an asset-heavy marketplace, because even though there's buyers sellers, you have a lot of work to do in the middle. And the key question there is, do you get paid for that work? That's because in the end, you don't want to. Marketplaces are attractive because when they start working, they often have network effects. Not always, but often. And those network effects can increase returns to scale of incremental customer adoption. And there's all these wonderful things that occur. But if you don't have the margin to play with because it costs you too much to make the marketplace work, then you don't get to enjoy those benefits. So that's sort of the question. Do you get paid for touching the assets?
Yes, I remember, looking into a few times into a asset-heavy marketplace that involved used apparel, where the average order value, and this company is out of business now, was like close to $100. But at the end of every transaction, what was going back to the business as net profit was $1.50. So clearly, they were more like a charity. They were not getting paid for all the hard work they were doing.
Yeah, there's a lot of asset-heavy marketplaces in apparel, and Poshmark, I think, which I mentioned earlier, has worked in part because it is very asset-light and therefore high margin.
Or sort of functionality light, in that they're not having to own the assets. But there's one thing every venture capitalist is addicted to and loves, and that's velocity. This is not interesting, this is. And there's one thing that I believe every venture capitalist hates, and that's friction. So the more you have to touch something, the more you limit the friction, the more friction you create in terms of growth. Right. In an optimal model, so think about a marketplace like The Real. They do have to certify that it's real. They have to process. They have to touch. It seems like a good business to me. I like the people that funded it. But it's to the extent you can remove friction, you increase your opportunity for velocity, and that is what people get excited for. And it's not just venture capitalists. If you look at public companies that trade at the highest levels, they trade with really great velocity and really great margins. And so it's sort of, you start there and go backwards, because everybody is funding along a chain of events to a certain point. And so when the assets have to be touched in any form, processed or owned, you really just meaningfully reduce that. And then, like we have a company called Open Door. They buy and sell real estate. I wouldn't argue that's a marketplace, but it's a great business.
Mm-hmm. Great. Well, we are out of time, so thank you so much to all of you. Really appreciate your perspective.
Thank you.